Hey, welcome back. It's JWalter here. In today's video, I'm going to be sharing an article on Forbes.com that actually was just published a couple of days ago. They basically asked industry experts about their housing market predictions over the next 5 years. So that's the topic of today's video. So if you get any value out of this video whatsoever, then please hit the like button. Also, consider subscribing as well because I post the latest housing market stats so you can make a more informed decision about whether you should buy or sell a house. So with that said, let's dive into today's video. Will the housing market crash? Experts give their 5-year predictions. This was just published on the 4th of April. This story on Forbes.com asked housing experts to give their forecast for the next 5 years, how investors are impacting the market, and what state or federal intervention is needed, if any. It says in this article that home prices continue to climb and the median listing price shot up in March to an all-time record high of $405,000. That is according to Realtor.com actually, but the key word here is listing price. Another word for listing price is asking price. So we're not talking about sold prices just yet. So even though the median listing price reached all-time record highs, it doesn't mean that people who will list their houses for sale will get their asking price, right? In any case, it says in March, the national median home listing price toppled $400,000 for the first time ever, landing at $405,000, according to Realtor.com. The median listing price has surged 26.5% since March of 2020, which is pretty astonishing. So many are wondering, are we entering into a housing bubble and will the housing market crash or at least deflate at some point in the future? So they basically asked nearly a dozen housing experts what their forecast is for the housing market over the next 5 years. While most of these experts predicted that home buyer demand is going to continue, there are also some warning signs ahead. So are we headed into a housing bubble in the US? So the Federal Reserve Bank of Dallas, they actually posted an article, a research article a few days ago about how we're seeing some early signs of a housing bubble brewing. I made a separate video about that with all the details, so I'll leave a link below for you guys regarding that. But here's basically a general summary, and they actually went over that here on this article here. Though the sharp increase in home prices in itself does not indicate a bubble, the report said, the report from the Federal Reserve Bank of Dallas, there are other fundamental factors, a keyword fundamental, to consider, including shifts in disposable income, the cost of credit and access to it, supply disruptions, and rising labor and raw construction material costs are among the economic reasons for sustained real home price gains. However, according to the Fed, what causes the housing market to be unhinged from those fundamentals is when there is widespread belief that today's robust price increases will continue. If many buyers share this belief, purchases arising from a fear of missing out or FOMO can drive up prices and heighten expectations of strong home price gains. Keyword there, expectations. They actually concluded in that report, though, there was no expectation from the fallout or a big housing correction like we saw in the 2007 and 2009 crisis, though. Meanwhile, though, household balance sheets appear to be in better shape and excessive borrowing does not appear to be fueling the current housing boom, according to the Fed. So here are some reasons why the housing market will likely stay hot, according to these industry experts. Most are predicting the market to remain strong for a while for several reasons. Number one, millennial demand for housing is up while Gen Z is right behind. So the number of potential homebuyers is plentiful. Millennial age or younger make up about half of the US population, and this is significant because first-time homebuyers represent approximately a third of all home purchases in the US, according to the National Association of Realtors. And most first-time homebuyers are younger than 40, which means the buyer pool is deep, a good indication that demand will remain strong, especially since housing inventory is at historic lows. So a lead economist at Sunday stated the following: "We won't see a downturn because the housing market saw little increase in inventory for the past 10 years. In a few years, Gen Z will be turning 30 and more financially ready to become homeowners. This means that the demand for houses will be high." So here's a really good breakdown according to the National Association of Realtors. I actually haven't seen this graphic before, but here's basically the home buyer generations and the share of those generations buying houses or have bought houses in 2021. So the vast majority of people who had bought houses in 2021 were actually older Gen Y or millennials, age 31 to 40 years old. That had made up about 23% of all sales in 2021. And then Gen Xers, who are age 41 to 55, That made up 24%, whereas younger boomers, 56 to 65 years old, made up about 18% of all home sales in 2021. A second reason why this housing market still may remain strong is because supply cannot keep up with demand. So obviously right now we have a big imbalance between supply and demand, and that's a primary reason why home prices have escalated so rapidly. So according to the executive vice president at RealtyTrack, after not building nearly enough houses for the last decade, home builders will take several years at least to add enough new supply to balance out this market. He's absolutely correct regarding this, because when we look at the total number of housing starts in the US over the past 15 plus years, you really can see this discrepancy because we have a lack of home building really ever since really 2009. So obviously during the 2005 to 2007 housing market, we had a ton of housing starts. Look at that. In February 2006, we had approximately 2.1 million housing starts compared to in 2009, we had 540,000. So as you can see here, the housing starts numbers have been increasing greatly. Of course, they dipped during when COVID hit, but right now we're at approximately 1.769 million housing starts for February 2022, and that's the most recent data that we have from the US Census Bureau. It goes on to say in a balanced market, the month supply would need to be around 6 months. I always say approximately 4 to 6 months. That's the time it would take to deplete all houses for sale at the current sales pace. But today's market has only 1.7 months supply, showing a drastic imbalance between supply and demand. So right now we're at 1.7 months, as you can see here on this Fred graph, 1.7 months for February. This is according to the National Association of Realtors. Compared to 1 year ago, February 2020, we had approximately 2 months. We really peaked last summer at about 2.6 months. So we have a long ways to go before we are even close to having a balanced real estate market, let alone a buyer's market, because we have a lack of housing inventory, of course. It goes on to say the following in this report, and I definitely want to clarify some terminology here regarding this. So it says new home construction climbed at an annual rate of 6.8% in February. That's for housing starts, but that's for total housing starts, not for single family houses alone. And that's the fastest growth since 2006. But the nearly 1.8 million new home starts are unlikely to put a dent in home prices. But when you look at the actual stats regarding this, have a look at this, because they're saying we have 1.8 million new home starts in the US, and that's really not really true, because when you go onto the US Census Bureau's website, the total number of housing starts is 1.769 million, so approximately 1.8 million. That's the $1.8 million number they're referencing there, but these are not all single family houses. This is actually single family houses, duplexes, and also quads and triplexes, as well as 5 units or more. So basically total housing units in the US for housing starts in February reached 1.8 million on a seasonally adjusted annual rate for February 2022. However, this again is multifamily plus single family houses. So when you actually look at single family houses, we're only at 1.2 million houses. That's an increase by 5.7% compared to 1 month ago. Whereas when we look at total housing starts, we're having an increase of 6.8%. So we're not seeing enough construction of single family houses in the US, and that's one reason why home prices have been increasing so greatly. And of course, this imbalance will continue to put upward pressure on home prices, even if they moderate from the peak pace of growth in 2021. However, I think a wild card there will be how mortgage rates change in the next couple of months, because in my personal opinion, if mortgage rates increase or continue to skyrocket, that could cause home affordability issues to be more and more of a big issue, and it could dampen home buyer demand, but time will tell, and I'll definitely keep you posted regarding that. So number 3 reason is borrowers are less likely to default on their mortgages. I absolutely agree with this 100%, because lending standards are so much tighter compared to 2008, 2007 era. And those approved for a mortgage nowadays are much less likely to be going through a default, because we don't have these bad loans called no-doc loans A no-doc loan was very, very prevalent during the 2007 and 2008 crisis, because with these loans, the applicant did not have to provide any documentation of income. So as an applicant, you can just say, I make $100,000 a year, and the lender wouldn't ask for any documentations to prove your claims that you actually make that $100,000. It was an absolute joke of a loan, and we don't have these in our marketplace right now. Also, there was more than $1 trillion in new mortgage originations in the fourth quarter of 2021, with 67% of those mortgages going to borrowers with credit scores exceeding 760. This score is considered very good according to FICO scores. And according to Zillow, what's much more likely is a gradual slowdown in the pace of price appreciation, where home prices continue growing, just not as fast as they are right now. However, there are some warning signs that could dampen our US housing market. Number one is that we could have a looming recession on the horizon. And of course, we have inflation at its highest levels since the early 1980s. In response to that spike in inflation, of course, the Fed increased the federal funds rate in March, and that was actually the first rate hike in nearly 3 years. So while the federal funds rate does not impact mortgage rates, it does have an indirect relationship to it. So I always say that an increase in the federal funds rate can increase mortgage rates, and that could slow down this housing market. Also, an increase in the federal funds rate also impacts credit cards and adjustable rate mortgages. Also, higher rates also could trigger a slowdown in consumer spending. Economists at Goldman Sachs estimate up to a 35% chance that the economy will go into a recession, which could impact or would impact the housing market. Meanwhile, because of this crisis in Ukraine, higher energy prices will continue to fan the flames of inflation, which along with higher interest rates could cause people to pull back on spending, which of course means that consumers will be less likely to potentially buy bigger ticket items like houses and cars, for example. Meanwhile, consumer confidence dropped to a 10-year low in March. I made a separate video about that as well, so link below. And of course, as the cost of goods increases, consumers tend to be less comfortable making big purchases like buying a house. According to CoreLogic, an aggressive increase in rates could bring about more softening, particularly in the housing market, especially if mortgage rates continue to spike. So if you're a home buyer right now, what should you do with this information? They say predictions indicate that home prices will continue to rise and new home construction will continue to lag behind. That means for some people, they may move to more affordable metros, and also they may stretch their budget or compromise on the size or other amenities in their home search. So here's two scenarios. You could buy a house right now, and that would mean there's a chance that you could also save by getting a house and locking in a rate before rates and home prices increase further. In contrast though, the opposite can be true. We also have a risk that limited supply coupled with rising inflation could get so extreme that it hurts the housing market and prices fall, particularly if the economy goes into a recession. So the president of the National Housing Conference stated the following: if we fail to address the shortages in housing supply, we run the risk of fueling the fires of inflation rather than extinguishing them. The result could be stagflation, which means high inflation and economic recession, which of course could devastate the housing economy. It goes on to say the following: if home prices drop suddenly, buyers could be stuck with underwater mortgages, which means they would have to stay in their houses for much longer than anticipated, or they will sell and lose money. However, they say this scenario is highly unlikely. They said this comes into play when people are paying for over the appraised value of a house. In my personal opinion, it can be very risky to write an offer with no appraisal contingency, and especially write an offer with no inspection contingency, because you want to get into contract on a house and do all your inspections. And if you find any major issues with the house, you want to have the opportunity to back out and get your deposit back. They also say an important consideration is how long you plan on staying in the house. And my personal recommendation is that if you plan to buy a house, basically during any time, is to own the house for at least 7 to 10 plus years. So that's my recommendations to you guys. But if you got any value out of today's video, then please hit the like button. I greatly appreciate that. Hope you have an awesome day. I look forward to seeing you on the next video.